Okay, now we'll look at this important concept of value at risk. What this says is, how much is my value? Value or amount is really at risk. So this again goes on a statistical calculation note. And the typical representation of this is like this: 1% daily VAR, let's say, is equal to 500 rupees. It means when I write something, so there are three aspects in this. One, there is a mention of percentage. Two, there is a mention of time period. And three, there is a mention of amount. Either amount or the percentage terms itself, something. Because we call it as value, it's better to establish in the rupee terms or dollar terms rather than percentage. So this is the typical representation of any VAR. So what it means is, there is a 1% chance, of losing more than 500 in a day. Yeah, more or 500 or more, greater than or equal to 500 in a single day. So 99% of the times my daily loss will be less than 500 itself. Daily loss means it could be a gain also. The loss value will be less than 500. 99% of the cases. So it also probably, if I try to extrapolate it a little bit, for every 100 days of data I look at, 1 day's data may be having a loss of more than 500, but 99 days it would be somewhere less than 500 itself. So this VAR is more like a measure. So if this VAR, 1% VAR is very, very high, it means that 99% of the times my loss is lesser than that, which means it could be a very serious problem. So the company's focus always is to reduce this 1% VAR or 5% VAR. In some cases they compute 5% VAR, and in some cases they compute the 1% VAR. And whereas in some cases, some regulations, like let's say like Basel, which is exclusively the set of regulations for the financial services industry, they also have specified what should be the VAR, and based on the VAR, how much capital do they need to set aside. So they have given their own set of constraints, or their own set of percentages and all that stuff. So depending on the kind of industry we are looking at, or depending on the kind of company we are evaluating, I would be interested in either computing the 1% VAR or 5% VAR or whatever. So what it says is that because there is a 99% chance that my loss will be less than 500, do I have a backup for that 500? Do I have a backup for that 500? Or what am I doing to face that 500? So which means 99% of the times I am more or less within that limit. My loss cannot go beyond that. So if at all it goes up to 500, do I have a mechanism to handle that loss? What are the steps I am doing to handle that, so that I am not, see, if it is very extreme beyond that 99%, or if it falls into that 1%, okay, that's an extreme risk. You need to think of some other mechanism. But at least 99% of the times, are you in a position to handle your loss? So sometimes it even says 99.9%. Basel actually specifies 99.9%. So which means only 0.1% is eliminated. So but for the remaining you need to have a backup. Right? So the way I have to compute this VAR, I need to find out how much is the amount that is subjected to risk. So once I know what is the amount subjected to risk, corresponding to that amount, I can get into the hedging process. Either by derivatives or whatever it is, I'll have to take those kind of stuff so that I will reduce my portfolio. I'll create a portfolio with derivatives or some other securities, just like futures. Yesterday we have used all that, whatever the instruments or options, using that hedge ratio and all. I'll get into those things so that I will reduce the value at risk. When I'm saying reduce the value at risk, 99% of the time my loss will be lesser than that much itself, which is giving me more and more confidence. The loss, the reduction in the loss is giving me more and more assurance and more guarantee that whatever I'm investing, I'll get a good return on that. So that is where VAR has become a very powerful tool. Of course, in some industries it is still a mediocre tool, whereas in majority of the non-finance or non-banking kind of industries, it is still a very powerful tool. Or even in the finance industry, it's a good powerful tool itself, provided the limits are set aggressive. But I mean, for a non-finance kind of industries, it's a very good tool in terms of how they should manage their risks. So now, what are the different methods that are available from the market data standpoint? I can apply it on almost any data, the VAR. So from a market data standpoint, I'll have three approaches to find out this VAR. First one is called as the variance covariance approach. The second is typically looked at as historical simulation. And the third is actually called as Monte Carlo simulation. Okay. Now we'll try to apply these three approaches on our data itself, whether it is on Kingfisher, Maruti, whatever we have collected, on any one of them we can try to apply the finding out of the VAR. The stock price data, on the stock price data of the company, because that is what is the market risk. See, credit risk we have looked at a couple of mechanisms. Using this, I would like to look at the market risk of the company. Market risk, see, market risk can encompass a lot of stuff. It could be because of stock prices, or it could be because of interest rates, interest rate fluctuations, or it could be because of exchange rates. If the company is heavily into international operations, the exchange rate can result in a market risk, or it could be because of commodity prices. So it's basically 4 different markets: stock market, bond market, forex market, and commodity market. So all the 3 methods can be followed for all to find out the value at risk. Probably for each of them separately I have to find out. For equity, what is the VAR? For stock exchange rate, what is the VAR? So overall put together is my total market risk. So now because the stock price data is available, we'll try to apply it on the stock prices. So because we have already computed the stock prices, right, we'll apply the VAR on the stock price data and try to see what is the value that is at risk for the company. Where is the data? You see, because you have to collect the data of all the interest rates over a period. You have to go to RBI site, download. There is not a readily downloadable format. You have to go to each weekly report, pull the data, and then download the stuff. So yeah, otherwise it would be a paid. Probably if your B school has subscribed to some of the databases. No, not in the money control. Okay, now using this, let's say because we already have the stock price data, okay, we'll do it on this one where we have Maruti, where we have taken the last 3 months stock price data, right? Now, when I have to use a variance covariance approach of finding VAR, the way it goes is the first approach is more like VAR is equal to the mean or the average, if I say 1% VAR, mean minus 2.33 times the standard deviation. And if I want 5% VAR, it is mean minus 1.645 times the standard deviation. These two numbers are actually based on the normal distribution assumption. If a particular data follows a normal distribution, the 1% area in the graph, in that normal distribution graph, the 1% area corresponds to a value of 2.33. If you can try that out, you use a formula called norms inverse. We are trying to find out the reverse. Earlier we used norms dist because we had a value and from there we found out the area or the probability. But now we are having the probability and we are trying to find out the value corresponding to that. So that's where I'll use the inverse and I'll give the input as 1%. You see, I'll get the same 2.33. 2.326 is what I am getting, minus 2.326. That is what I have typically used for a 1% VAR. Similarly, when I use it for a 5% VAR, in the same norm S inverse function, you put it as 5%. It will give you that minus 1.645. So the formula, whatever we are using, so what it means is, if I have to put it, if I assume that these are my returns are following something like a normal distribution, because finance and normal distribution go very close hand in hand. Right? So almost all the financial assumptions go with a prime assumption that the returns follow a normal distribution. Right? So when this is a normal distribution, what we are saying is, if this graph is having a 100% area and the center here is the average return, so we are talking about some standard deviations this side in the returns. When I say 1% area from this side, let's say this is the 1% area out of the total area, what is the value of the standard deviation, or what is the value of this normal distribution corresponding to this 1% area, which means these are all the losses greater than this number, right? Or losses lesser than this number. Only this side the profit is lesser than this, which is loss is more than this. So we are trying to find out this number, which is arrived at through this formula. Average minus 2.33 times the standard deviation for a 1% VAR, and for a 5% VAR, average minus 1.645 times the standard deviation. Now just trying to find out the daily average is one more thing which I will take. So which I will take as the average of this O column itself. This is my average. Now what I am saying, through the variance covariance approach is 1% VAR is average minus 2.33 times the daily standard deviation. So this is my 1% VAR, and 5% VAR, I'll interpret that 5% VAR is coming out to mean minus 1.645 times this number. This is the one. Daily standard deviation. The returns on the x-axis. So average is in the middle. So returns on the x-axis. So all the positive returns will be towards the right. See, the average return will be here. Yeah, 1% is this side. Loss. Not profits. See, this is your... See, you want to determine this number where 1% of the graph is below this and 99% is to the right of this. So at that particular number where 1% is left, 1% is to the left of it, 99% to the right of it, which means 1% of the values are lesser than that, and 99% of the values are greater than that. So that point I call it as my 1% VAR. So in this case, I have got it, let's say, as 4.9%, 4.965%. This thing I have to convert it into some amount. So this is the percentage. So probably if I multiply it with some, for every 1000 rupees or something, right? If my investment is, let's say, 1000 rupees, what I am saying is, I'll multiply this number by 1000. Some 49 rupees is the loss. Here also, if my investment is 1000 rupees, I will multiply it with this one. Now what this is telling me is, for every 1000 rupees of investment, right? If my investment in something is 1000 rupees, there is 1% chance that my loss will be more than 49 rupees in one single day. 99% of the times my loss will be less than 49. It could be a gain also, but loss is less than 49 in a single day. So it's like there is 1% chance, let's say 1000 rupees, one share, or probably let's put it on one single share. What is the share price? Okay, one single share right now is around 1103. The last price 1102. The latest price for this company is 1102. So what I'll do is, instead of multiplying with 1000, let's assume that I have purchased one share of Maruti. If I purchase one share of Maruti, what it is saying is, within one single day, I can lose less than 54 rupees only. 99% of the times, my loss on a single day cannot be more than 54 rupees. Only there is a 1% chance that I will cross 54 rupees loss on one single day. Now, my intention is, can I reduce that number a little bit more? Can it be brought down to 20? Can it be brought down to 15? Can it be brought down to 10? If it can be brought down to 10 or 15 or something, obviously it is giving me more and more confidence. Just like the sigma, when we did for futures, the sigma versus the portfolio sigma, we were able to bring down the sigma drastically. When the sigma comes down, even the VAR will come down. Because VAR is nothing but average minus that much times the sigma. Sigma is coming down, the VAR will come down. Probably we should look at on the futures contract which we have done on Infosys. Right. Yeah, yeah. Daily average is just the average of these numbers. O column. So we probably will go back to our Infi futures chart. We have already calculated the standard deviation and all that stuff here. Right. So let's say here, this is yesterday whatever we have computed. The standard deviations were initially 56 and the returns were something like this. And then we talked about the combo and the VAR. I mean, VAR now, if I compute using the same concept, 1% VAR, it is nothing but the average. Let's say only for Infosys I'll look at. It is the average minus 2.33 times the standard deviation. So what has happened? It has become, so there is a 1% chance that my loss is more than 138 rupees. Right? There is a 1% chance that my loss is more than 138 rupees. Whereas when I make it as a combo, 1% VAR for the combo, now because the standard deviation is reduced, the average minus 2.33 times, this is the standard deviation. It is directly saying from 138 rupees loss, I am able to reduce the loss to 39 rupees, which means there's a lot of confidence that is going up. It's like, instead of saying my loss will be less than 138 rupees, right? Probably 1% if I ignore and make it in a plain layman's terms, my loss will be less than 138 rupees versus saying my loss is less than 39 rupees. The second one is a more of a positive statement, right? My future loss in one single day will always is less than 138 rupees versus less than 39 rupees. When I say less than 39, it's coming more and more towards profit. Right? So the intention of the companies always is to reduce the VAR to a large extent by building these kind of portfolios. Right? You see that the portfolio VAR has greatly reduced. Just by getting into a futures contract here, I am able to reduce the VAR from 138 to 39 itself. Okay, combination also we can take the mean. Okay, the combination mean will be the average of these two. Yeah, we'll take the average of these two. So we'll take the combination mean as the mean of these two numbers, which comes out slightly higher. So probably here also, instead of this value, I'll take this value, which is just around 40. But still it's a good decent number itself. Simple average of these two. Just use average formula equal to average of those two numbers. This comma this. Yeah, 2.33. Right. Around 40. If I go only for the stock, I am simply saying there is a 1% chance of losing more than 138 rupees. Whereas in the second case with a portfolio built, I am saying there is a 1% chance of losing more than 40. Second one is looking more and more positive statement. Right? Okay, I'll lose. But the loss is not more than 40. It's as good as if I have to put it in plain terms. My loss is not more than 40 versus my loss is not more than 138. Second thing looks more and more positive. Right? More less is not more than 40. So once I calculate my VAR, I can very well make out what is the total amount that is at risk and what are the mechanisms, just like this as we are saying, what are the mechanisms I can get into to reduce that VAR. So derivatives are one of the good mechanisms that can be used for reducing the VAR. So on a day, if I can lose this much amount, if I can lose up to 140 rupees, what is the way out to reduce that? Right? Can I reduce it or should I be prepared? Okay, even if 140 is lost, is it fine? I mean, do I need to bear with that? Do I need to go with that? That is what. So now when I create a portfolio, it is directly reducing. Probably if I combine some more options or something on the top of it, it can even come down. So the more and more I am able to reduce my VAR, it is adding up to my benefit. Right? So this is one method where I use a variance and covariance approach to find out the VAR. Then we also have a historical simulation approach. Historical simulation approach is nothing but, see, for that it requires a very large volume of data first of all. With just 3 months data, it's not that easy to do a historical simulation approach, because it is nothing but, as the word itself is saying, you observe the historical data and from there you extract the VAR. Straightforward, no other, no standard deviation, no mean, don't go with anything. What it simply says is, 1% is very difficult with this small data, but we'll say the 5%. What it simply says is, try to get, once you have computed the returns like this, pull out the 5% worst return. The worst 5% of the return. See, out of the 90 days, or we have, I don't know how many, 60 days, 70 days, whatever is the total days, out of these many days, what is the worst 5% value, or what is the worst 1% value? Take that value and report it as your VAR. What is your worst 5% value? So it's as good as pull out the smallest 5% value. So when I say your data has 60 elements, let's assume that your data is having 60 days of data. The 5% VAR is the worst 5% of 60 is 3. 60 into 5%. So the third worst value out of all the values is your 5% VAR. Right? So for that, I'll simply use a formula called small. It's a percentile. So I'm simply trying to pull out the third worst, or 5%. So it's a percentile itself. Or let me see if I can use. I can very well use the percentile formula, where I can say within this, give me the 5 percentile value. The 5 percentile value. So which is, it's like a third worst value in the total data. Or if I want the 1 percentile value within this data, take 1%, which will give me this number. So now you see these two methods have given more or less in the same way. My 1% value is this much. So what you can very well do is this number multiplied by 1102 is your VAR through the historical simulation approach. This multiplied by 102 is your 5% VAR per one share of Maruti. So it's like if you have invested 1102 rupees today, if you have bought one share of Maruti today by spending 1102, tomorrow there is a 1% chance that you will lose more than 49 rupees. Your loss will be more than 40. There is only 1% chance that your loss is more than 49 rupees. 99% chance that your loss is lesser than that. What we are also saying there is, okay, I mean, you will not lose more than 49 rupees to a large extent. So if you can reduce this number, I mean, what companies do using this is, do I have some kind of backup for this 49? 1. 2. Can I reduce this 49 to some other number? Probably 9 or 2 or 40 or 20 or 15, whatever, by doing some kind of portfolios, so that I'm going more into a safe zone. Because if I lose 49 in one single day, only one alternative. I should have something as a backup. Think of a company which has invested. On one single day, if its value is down by that much, if it goes bankrupt because of that, so it should have some kind of backup to address that, which is more like a risk absorption, or it should reduce that number. Now if I see the same numbers, let's say for Kingfisher, we'll see the same numbers. So daily average, I'll take for Kingfisher also, average of this number. This is my daily average, and from there I'll try to find out 1% var and 5% var. 1% var is coming out as average minus 2.33 times the sigma, and 5% var is coming out as average minus 1.645% times the sigma. Now if I had invested the same 1102 in, just to compare these two, if I have invested the same 1102 to buy so many, whatever are the number of shares of Kingfisher, how many, whatever I may get, on 1102, on one single day, I may lose 127 rupees here at 1%. And at 5%, I may lose close to 91 rupees. So which is much different, which is much higher compared to Maruti. 54 and 39, whereas here it is 127 and 91. So my loss is much higher. So this is a way. So this stock is a much risky stock compared to Maruti stock. Probably even if I use historical simulation also, so I'll use percentile. In this data, the 1 percentile value. Again, this is also showing almost 9.4%, very high. Similarly, here I'll use percentile. I'll use 5% value. So even this also, if I multiply with 1102, 103, which is, I mean, see, different methods are giving me different answers, but you see the relationship is not getting changing. Right? Probably some value may be high, low. We are not looking at the mathematics in it. We are looking at the decision in this. At least it is much more riskier compared to the other one. So this is one approach. Right? So either I can use the historical simulation approach or I can use the variance covariance approach. But see, again, another way to look at it, if I see, people may talk about, okay, I'll create a portfolio. I'll add one more security to this, or I'll add a future to it. I'll add an option to it. But after I add, if this number is not coming down, there is no use of the add. See, after I add one future to it, let's say, or after I add one more stock to it as a portfolio, if I am not able to bring down the VAR, if the VAR is still 103 only, then that addition of that security is of no use to our portfolio. So the addition of any amount of securities, whether it is stock or whatever, to your portfolio, unless it can reduce your VAR, it has of no use. Right? So that is one more way people depend on determining the VAR. Now, the third aspect is the Monte Carlo simulation aspect. This is, I mean, this actually goes as simulate. You simulate a scenario based on the concept of random numbers. You simulate the returns. See, Monte Carlo simulation is nothing but you try to generate these numbers based on the assumptions, based on the mean and the standard deviation, based on these two numbers, it's like reverse calculation. You take the mean and average of the values, mean and standard deviation. Based on that, you generate your data. It's basically like, okay, if I say taking the mean and standard deviation and using random numbers. So see, it's as good as like this. I want an output. I want to ask someone what is the average height of an Indian male. Okay, there are multiple ways of doing. One person goes and takes a survey. Each person's height, whatever, some sample, each person's height, and after that just does an average and something, and he projects. So for that I have to go to thousands of people and measure their heights. The other way is, if I have some report which actually says this is the average height, but I have to show that I have done the work. So I'll have to generate the data so that it generates exactly the same average and exactly the same standard deviation. I can depend on the simulation. Of course, a lot of places where people use is, see, sometimes we say the growth is 8%. Are we so much similar to God, where are probably some Baba who can directly say, when I say 8%, the growth will be exactly 8%. We are nowhere closer to that, right? So it could be somewhere between 7 and 8%. Let's say, if some growth I want to forecast, I'll say 8%. Obviously, it cannot be 8%, right? Very, very little chance that it would be 8. Probably if I say it may be between 7 and 8%, probably our forecast is much better compared to saying it will be 8%. Either it should be a match fixing, or we are next to God. Probably we can open a different shop for that. So only these possibilities where our forecast exactly matches the actual. So because it lies between 7 and 8%, what we can do is, okay, some number randomly between 7 and 8. Right? So if I give some kind of an input, generate some random number between 7 and 8, following some kind of a distribution. Here it's a normal distribution. So that the average is equal to this and standard deviation is equal to this. So it's as good as actual data generated based on the solution. At majority of the cases, we cannot get the data. From the summary available, we may have to work backwards and generate the data. This happens in a lot of business scenarios. So in those cases, Monte Carlo simulation is a very powerful tool which will help us in generating the data. The moment I know this is the pattern, based on the pattern I can generate the data using the Monte Carlo simulation. Now let's say if these are the two parameters, this is the mean, or this is the mean, and this is the standard deviation, and I am making an assumption that the values will follow a normal distribution. The returns, we are making a direct assumption in all finance stuff that the returns will follow a normal distribution. When I try to plot a graph for them, it will come more like a bell curve. Now, the way and the advantage of Monte Carlo simulation is you can generate as much data as possible. 1,000, 5,000, 20,000. So it's as good as you have, with the same characteristics, you are collecting as much data as possible. See, now here we had a limitation with our historical simulation. Only 60 data, last 3 months data, only 60. So out of that, it has given our 1% and 5%. But if I, instead of 60, if I have 5,000, probably that 1% is a very good, better number to arrive at. So that is what we are trying to do through the Monte Carlo simulation approach. Now, simple way to generate Monte Carlo simulation. I'll start right from the first row. Because I am assuming the distribution is normal distribution, I am using something called norm inverse. Not norm S inverse, it's a norm inverse. Because I can give a mean and standard deviation here. I'll take it as a norm inverse. In the probability, I'll put something as rand function. It's a random number. Some random number you generate. And the probability, the rand function actually gives some number between 0 and 1. The probability also lies between 0 and 1 only. So that's where I am using, instead of probability, instead of giving some probability number, I am asking the system to generate some random number. Now if you see probably the rand function, you just use rand. You'll get some number. It's just a random number between 0 and 1. If you just refresh your data, the numbers keep changing. We are hardly bothered because we have generated, so that's where it will not work for one data or two data. The large numbers I take, here if it is less, next it will be more. But at the end it will follow something. If you just try to see, if you just put on this entire thing, if you see the average here, the average that is shown at the bottom, more or less it's the same as your number. You try to look at your average, minus 0.002. More or less up to 3 decimals, 4 decimals, it's the same. And even you try out on your standard deviation of this data, of this same data, let's say I want to take the average. The average of this entire data more or less will match. The average of this entire data, it's almost matching. And similarly, you take the standard deviation of this entire data, that will also match what you have taken. Yeah. I mean, for standard deviation also I am. So it is as good as, you see, 0.020, at least up to that level it is. So it's as good as your generated data, right? So, but instead of going with the actuals, once you know some parameters, you can use those parameters to simulate, which means that is giving you the scope for large data access. And for VAR, or in the risk management industry today, simulation is the most adopted format, because there the people see, in all these finance decisions, the answer is not important, the decision is important. So the more and more data I have, there is a scope for taking a better decision. So out of the three models which I am discussing, the most preferred model for the VAR is the Monte Carlo simulation approach itself. So here how will I do the VAR is, the 1% VAR now, for me, it keeps changing, hardly matters. Let it change, because it will give us so many scenarios. No, you make any editing anywhere, not here. Any cell editing anywhere, this keeps changing. If you say I enter something, I type some text. So what happens with this is, different scenarios get generated. So you will know in different scenarios what is happening to your VAR. It's like your real world situation. What is happening to your VAR? So finally you may say, okay, my VAR will lie between this and this. You will run it probably again the same thing. You will observe by changing the data 10 times, 20 times. You will see in what range the VAR is lying. So instead of giving one bullet number for VAR, you will say probably the worst VAR is this much, the best VAR is this much. So now let's see here. I'll just take the same percentile on this data, the 1 percentile. So again, more or less the same number. Yeah. So both of us are getting more or less the same number. So this multiplied by 1102, you will get a different number. Once you change it, you will get some other number. But it will not be, see, it will lie between a certain range only. Even if you try it. It will not go beyond a certain. So it will give you all possibilities. Okay, now you try refreshing it. 4.93, 4.99. I'm getting more in that range itself. 5.1. So at least it will tell you that your VAR can lie only between that. Now you see I got 54 point something, 4.93%. Now again I refresh it. I got 5.05%. So it is taking all possibilities. Now when I pool a good number of possibilities, I'll get it within this range. So I'll say my VAR is probably between, so here even if you see it is 55 rupees loss. Earlier it was 54. But 54 and 55 hardly matters. It will not be, I mean, we are not talking about, we know that much has to be controlled. Probably again in the same range. It will not be too much drastic. The more and more I simulate, instead of 1000, 10, 2000, 10,000, 20,000, there will be a lot of consistency in the solution. So the VAR is a much better solution today using the Monte Carlo simulation approach. There are a lot of applications of Monte Carlo simulation today in the risk management space. And it requires identifying the distribution. Here we have identified it as a normal distribution. So depending on that distribution, we'll use that corresponding inverse function. Like normal, so we have used norm inverse. If I say it is binomial, I'll use binomial inverse. If I say something else, I'll use that something inverse. So Excel has given at least 10, 12 distributions like that. So for that, I need to understand what those 10, 12 distributions are, which data follows which kind of a pattern. And based on that, I can simulate the values from the backside. So even for a 5%, I'll use the percentile of this, comma 5%, which will be more or less similar to our numbers. But see, in reality, we will never have a bullet point. We'll only have a range. But when I go with all those approaches, there will be only a bullet point. But here it is not the case. Here I'll get constantly changing values. So I can easily observe what could be the possibility of the VAR in this case. So I can at least observe so many times. So because I am observing the data so many times, the accuracy level of my forecast is much more better. So that is where my Monte Carlo simulation will really help me out. Right? So for the calculation of the VAR, but in all the cases we see almost 54, 49, 54. That is what is my number. My intention is if I go for a portfolio or if I do something on the top of this, some derivative or something, that number should come down from 54 probably to at least 25, 30 or something, which is a drastic reduction from the existing number. Through any of the approaches I do, the number should come down drastically. Only then it is worth adding that particular security to your portfolio. So that way value at risk is one important and powerful tool, especially in the risk management industry today. Right?